Good morning and welcome to Bloomberg UK. I'm Tom McKenzie in London. This week we focus on the UK's inflation problem and the headache it poses for the Bank of England and number 10 Downing Street. The latest UK inflation print has surprised to the upside. CPI in the year to March stayed in the double-digit range again at 10.1%. Wage growth for February also came in hotter than economists' expectations. Now, the pressure is on at the Bank of England. Policymakers, led by Governor Andrade, had previously expected both pay growth and inflation to cool. Bloomberg Economics has also scrapped its pause forecast. Our team now sees a 25 basis point hike at the next BOE meeting on May the 11th. With the data hotter than forecast, interest rate traders are also now converging on a terminal rate at around 4.85%, close to that 5% level. And a terminal rate of 5% is very much within the realm of possibility. So let's take a deeper dive into what the latest data means for policymakers at the central bank, in terms of politics as well, and bring in Andrade, Bloomberg Economics' Europe economist, and Bloomberg MLive cross-asset strategist Ven Ram. Good morning to you both. Thanks for coming in and joining on this discussion. Anna, let's start with you then. What is happening with UK inflation? We're the outlier now. I'm thinking of Europe, a little under 7% in terms of CPI. The US at 5%. We're at 10.1%. What is going on?
OK, so just two different things with the data. The first one is that it essentially suggests that underlying cost pressure is much stronger than we anticipated. That's something we just have to recognize, and that was also reflected in the pay data. The comparison with the euro area and with the US, I don't think it's super fair. Well, with the US, just because it didn't face this massive energy shock that the UK still and Europe faced. And also with the Eurozone, in March, the Eurozone benefit from energy base effects. So this kind of effects that will mechanically bring down inflation in the UK, and that we will only feel them in April because of the off-gem cap. So that kind of explains a bit, some divergence trends.
OK, you don't think it's fair. There's the terminal chart showing where the UK lies versus its colleagues in Europe, in terms of the CPI, of course, and the US as well. So we are the outlier, but you're pointing to some important differences there. Anna, what is the Brexit effect on UK inflation?
So right now, so there's no doubt, and we've put some research out there saying that Brexit will have an impact on the economy. That's kind of clear in GDP and in investment numbers. But in respect to inflation, we just don't have enough information to say that it's Brexit. And I'll just add two things. One is on food. If you do look at food, the sort of surprises that you got in food inflation in the Eurozone and in the UK have been broadly the same throughout 2022 and in the latest data releases. The second is core goods. And there could be, not sure if a bit of Brexit effect, but there you do see some signs of strong corporate pricing power, and that can make inflation more persistent. The BOE is worried about that. Whether it's due to Brexit or not, we cannot really tell. But so far in the data, there's just no obvious signs that it's...
OK, from Brexit to breakfast, because we have the breakfast index, and we see the gauge has gone up, 23% on a yearly basis. We're, of course, talking about the staples of every English home's breakfast. I mean, that is a complete stereotype. But nonetheless, sausages, bacon, mushrooms, baked beans, tea and coffee, all up collectively as a basket, about 23% year to date. Those gains are coming through. That is essential in terms of the inflation picture in the UK. Are we getting a sense, Anna, that those prices are anywhere near peaking?
There's some uncertainty there just because, producer prices for food kind of pointed to a downward trend, and that's just not been reflected. That was also the story in the Eurozone. So there's a bit of a question mark there. But I would say that we got more surprised on the CPI data. We got more surprised on the core inflation, which is the most problematic bit. So both services and core goods were actually stronger. And I think that's kind of where the BOE will be concerned about.
OK, so they're concerned more about core than necessarily what's happening in food prices. Ven Ram, let's bring you in. At this point, you've been pretty prescient in terms of your calls on UK asset prices as a result of the inflationary inputs coming through. Is it your assessment now that we're right to be pricing in close to 5% from the BOE?
I think we're absolutely right to be pricing in 5%. If you look at the real rate curve in the UK, Tom, we are doing just about 30 basis points on the one-year tenor. And this perhaps needs to move up to at least 1% for the tightening to bite. And what will cause that shift from 30 basis points to 1% on the real rate curve? You need a big move up in the nominal rate curve, so which means that 5% on the nominal benchmark rate from the BOE may indeed be required. If you look further out the real rate curve, it's also inverted. The key parts of the curve, the 5-year and the 10-year part of the curve are inverted. So basically, they're at zero now, and those need to push higher as well for the tightening to bite. So net-net, we are indeed looking at a terminal rate around 5% for sure.
Wow, a terminal rate of around 5%. I just wondered to what extent investors have adjusted to that. In fact, households as well, as they look at their mortgages, Ven Ram. I'm looking at the front end then, 380 on the 2-year, and you've been discussing and pointing to that bear flattening that we've seen. 380 on the 2-year, 382 on the 10-year. Ven, what does this mean? The ride-up in gilt yields, it's not happening today, but we saw a significant ride-up yesterday. And the views on 5% terminal rate, what does that mean for pound strength coming through in the weeks and months ahead?
Well, the pound has come back more than 20% from its lows last year. And we have known for a long time now that the UK economy is likely to slow this year. So in other words, the pound is doing something different to what the economy is doing. So there is something driving the pound despite the gloom and doom. And what is that factor? That factor is the dollar weakness, broad dollar weakness, stemming from the fact that the Fed is approaching the end of its tightening cycle. In such a scenario, the euro will be bid, and the pound will outperform the euro. And this is the key thing that the markets have been missing. And I've been saying this from the start of the year, the pound is going to rally, and it's doing a 125 thereabouts now. But I do think that it's definitely got more upside in the months to come.
Yeah, you were the contrarian at the beginning of this year, Ven Ram, with that call for stronger pound. 124, as you say, close to 125 on pound dollar. You had the view from Jeremy Stretch earlier, you get to 126. He's not really buying the view that you get 130 on the pound. Where do you think it ultimately tops out? Do you have a view on the next level?
I do think that 130 is definitely doable for sterling, particularly later in the year. I think what the markets are waiting for is confirmation that the Fed is going to stop. And if the Fed starts cutting rates, as the markets are speculating they will by the end of the year, I think that the dollar has big downside. That will push up the euro, and that will push up sterling definitely towards 130 levels.
OK, Anna, if you align with the view from Ven Ram that you get to potentially 5% on the terminal rate, but if you do, as a proposition, what do you think that does to the UK economy?
Yeah, so I think if we do get there, it's because the BOE sees that the underlying cost pressure in the economy is so strong, and that there's some sort of inflation. The inflation psychology has changed, that it needs to take rates that higher, because internal...
Sounds like you're sceptical.
Well, internal research from the BOE has pushed back on that terminal rate before in the trust period, and there's also internal research saying that at 5%, that's really when households' resilience starts to be tested. So I think that I do see like the risks of 4.75, like 4.75 is very plausible, but the bar to get to 5% is just a bit higher. Not impossible, but just a bit higher.
What does it mean for the housing market? It's already under pressure. Is the housing market able to slow without completely cracking?
Yeah, I mean, the important thing is really what we'll do to the economy. So right now, our call is for the UK that will dodge a recession. We see the UK growing by 0.1% this year. The question is, if you take rates that higher, then the second half of this year won't look as good, and neither will the start of next year. So there we will potentially be looking at the recession there.
There's been a bit of head scratching from some people around the strength of the UK consumer, despite this cost of living crisis, historic cost of living crisis. Does that resilience, do you think, hold up into the second half?
Well, part of that resilience was probably driven by the fiscal support that we saw last year, and also the labour market strength that we've seen since the start of the year. I mean, last year we were probably expecting the labour market to be cooling much faster in this period than we are actually seeing. And we are now forecasting the unemployment rate to remain unchanged until the mid of this year. So this is, strong wage growth, all of this recovering confidence that you are seeing in the confidence indicators. This is kind of propping up consumer. But once the labour market starts to tighten, policy rates have kicked in, but they've not fully kicked into the economy. Once that starts to happen, then the labour market will cool, and then, maybe this consumer strength will be a bit weakened.
A cooler labour market, wage growth is accelerating, but still on real terms, of course, in negative territory. Does it pull more workers into the workforce? Does it address some of those participation concerns that we have around UK labour force?
Yeah, well, forecasting participation has been, tough over the past months, just because we've been kind of constantly surprised with how tight the labour supply has remained. But it's true that in the latest data, we have been seeing kind of people coming back to work. So right now I think we have 170,000 workers missing compared to the pre-pandemic. This was close to 500,000 in the middle of last year. So there's a trend that kind of suggests that the real income squeeze is starting to bite and people kind of need to go back to work.
Okay, really, really great analysis. Thank you, Anna, for joining us in the studio on the topic of UK inflation and the prospects for the UK economy. Anna, Andrade and Ven Ram from our MLive team with a view that maybe rates here in the UK get to 5%. Thank you both. Right, coming up, we're going to continue our conversation on the health of the UK economy. We're going to bring in Josie Anderson, Managing Economist at the Centre for Economics and Business Research. Joining us next. This is Bloomberg.
I'm sorry, they got it wrong. Hopelessly so. The evidence is overwhelming. And it's puzzling in a way that the central bankers continue to resist this. I find I've been commenting on the Bank of England best part of 50 years now. I have to tell you, the current lot is some of the worst I've ever commented on.
OK, we're hearing there from Tim Condon, former advisor to Prime Minister Margaret Thatcher and, of course, a famed monetarist in terms of his economic theory and thinking, talking and speaking to Bloomberg Radio. He also went on to say the UK is heading for a recession. Well, let's get some analysis then and some reaction in terms of what is happening across UK GDP. It flatlined, of course, in February on a monthly basis, though there was an upward revision to January's reading. The IMF has also warned that the UK is set to be the worst performing country among the G7 nations. Of course, the Chancellor of the Exchequer has pushed back on that view from the IMF and pushed back here with Bloomberg TV. Let's bring in now Josie Anderson, Managing Economist at the Centre for Economics and Business Research for the analysis and the context. Josie, thanks for coming to the studio. Really great to have you in. Let's start with the GDP picture then. And we heard there from Tim Condon saying we're heading for a recession. The Bank of England's getting this all wrong. Money supply suggests that we're not only going to be coming out of inflation, he thinks we're getting into deflationary environment. It's an outlier view, but what is your take in terms of the shaping up and the outlook for GDP out of the UK towards the end of the year?
Well, GDP is an interesting one, actually, because the February data surprised on the upside. We saw a strong January, no contraction in February, kind of a flatlining economy. So it makes a contraction in Q1 far less likely. You'd have to have had a really weak March. Now, that's still possible, but I think the big picture, rather than declining GDP, is flatlining GDP. We can compare to 3 years ago, pre-pandemic, February 2020, and we've seen a tiny bit of growth, 0.3%. So obviously we had the big recovery from the COVID contraction, and now the big picture in the UK is flatlining. So whether or not we'll see an actual decline in GDP this year is the big question. Will there be a recession? Prior to the February data, we're forecasting a 0.2 contraction over the whole of the year. I think it's likely that in our next forecasting round at the end of the month, we will have a slight upward revision, actually, because I think the UK economy has been surprisingly resilient. Consumers, despite this huge cost of living crisis, continue to go out and spend. So actually, yes, very weak GDP. We should be seeing growth. In the 3 years to February 2020, we saw 4.5% growth as a whole. Now we're talking basically no growth. But it's, whether or not there'll be a recession is hard to say. It's flatlining.
So I want to unpack your views on where that relative resilience is coming from in just the next couple of minutes or so. But in terms of that stagflation view, or at least stagnatory view when it comes to the UK economy, as you project out to 2024, if you can do that, given all the uncertainty in terms of economic data, is this the near-term, the medium-term future for the UK economy, that we're going to be a flatlining, stagnant economy?
We do forecast a return to growth because ultimately I think one of the main sources of this flat GDP growth is the cost of living crisis. And we are forecasting inflation to fall, and with that, consumers should be better off. But, despite forecasting growth in the coming years, it's going to be weak. It's not going to be a strong economy because consumers are going to take time to recover from this big cost of living crisis. And, of course, all the other shocks we've faced in recent years, obviously, we're still, to some extent, recovering from the pandemic and the associated supply chain issues globally, and also, of course, the war in Ukraine. So growth's going to be weak. And, it's to do with the cost of living crisis. There should be a bounce back.
And inflation, of course, central to that cost of living crisis. 10.1% in the CPI print. We're an outlier versus the US and Europe. What is your forecast now for inflation by the end of the year, with a government that has set itself a target of halving inflation by year end? Do they get to their target? What's your forecast?
Yeah, so actually consensus expectations were, it would fall below 10% in the latest data, but actually we were expecting it to remain above 10%, but we are expecting it to fall over the year despite that. There are lots of forces pushing inflation down. The main one is, of course, energy, and we should see that come through much more strongly than it has already in the April data and also in the second half of the year, as the effects of the wholesale energy prices are passed on to households, which can take time in the UK because of our energy price cap and the way we work.
What about core? What about services, that component, and are the rate hikes that are expected to come through from the BOE, are they going to be enough to get that core down and away from its stickiness?
Yeah, so like I said, there is a big force driving inflation down, but actually, on the other hand, it's sticky, as you said. So we're not forecasting it to fall dramatically. We're not forecasting deflation. I think it remained high in the data we got yesterday because it can be sticky, and it's sticky, because companies get used to higher price rises. They in a way can profit off it if they face relatively inelastic demand. And also, workers can bargain for higher wages in some industries. And there we see higher wage growth, higher than expected in the latest data. So that's where inflation can be sticky in the industries that can kind of get away with those increases. And so, we're forecasting an averaging of 4.5% inflation over the last quarter of the year. So, yes, a halving, but
and that's dependent on how many hikes from the Bank of England, because we were speaking to our rate strategist, Ven Ram, earlier on the show. He said he has 5% in view now in terms of the terminal rate from the BOE. Do they have to go that far to get inflation to your target?
Yeah, we're forecasting one more rate hike. We were forecasting that before the data.
25 basis points?
25 basis points, yeah. So up to 4.5%, and then we're not currently forecasting any more rate hikes. I think, we were expecting, higher inflation in the March data, but we are also expecting it to come down. So April will be key for the decision after the next one. The Bank of England will really be looking for slowing inflation, but we are forecasting 4.5%.
And you think the door opens to cuts from the Bank of England before the year is out?
Yeah, right at the end of the year, possibly December, and no dramatic cuts. But, if the Bank of England starts to see inflation falling and is dealing, with a very weak flatlining economy, it might start to think, how can we spur on some demand, actually? Because right now it's kind of focused on getting that demand down, and it's hurting consumers, it's hurting households. But at the same time, that's the main method they have to deal with inflation, it is impacting demand and,
Just
making consumers...
Very briefly, on the housing market, how fragile is that?
Yeah, so I think this is where one of the key areas where the UK is weaker than other countries, in that it has a stronger reaction to weakness in the housing market. And we are forecasting a fall this year of a 3.7% contraction in prices. That's an improvement on previous forecasts. The housing market, like the whole economy, seems to be more resilient than previously forecast, because obviously we have, we've had these huge increases in interest rates from the Bank of England, and that's impacting mortgage holders a lot. And so mortgages have become a lot more expensive. But yet, the housing market seems to have been quite resilient. But a contraction will impact, it has big wealth effects in this country. A lot of households will feel poorer if their house price falls. And of course, you get significant impacts on certain people. If they can't afford their mortgage anymore, they might have to sell their house.
OK. Josie Anderson, smart insights. Thank you very much for coming into the studio. Josie Anderson, managing economist at the Centre of Economics and Business Research. Coming up, what European city are Wall Street bankers now banking on after Brexit? We'll give you the answer and why after the break. This is Bloomberg. Economics, finance, politics. This is Bloomberg UK. I'm Tom Mackenzie in London. Now, for decades, London was the main nexus of European finance. But 2 years after Brexit became a reality, there's been a clear shift across the channel. That is the subject of today's Big Take. Joining us for the details is Bloomberg's Alex Raj Bandari. Alex, is there really life after London then?
Yes, there is life after London, Tom, and it seems to be in Paris. There was a lot of debate after the Brexit vote about which city in Europe is going to win the big chunk of the financial industry that the city was representing for decades. And it seems like Paris has been getting a fair share of it. In terms of trading, it's become the main European hub for trading on the continent now. And banks have been pouring in talent and relocating people and hiring people here. When you look at JP Morgan, they have a 22-fold increase in terms of traders in the city. Citi is building a new trading floor. Goldman Sachs has a new building across, just a throw stone away from the Arc de Triomphe. So banks have been betting big on Paris, and now we can see there's a new ecosystem building around finance in Paris. And that's not just banks. Hedge funds have been following the trend. If you look at Millennium,
Does that momentum, does it have momentum, that kind of investment? Does it keep going? Or do things like the protests that we've seen across France put a bit of a headwind on that?
Well, I mean, protests are quite temporary. And when you look at the decisions that banks have been making in terms of relocations and investment and loan books that were moved and transferred to Paris, eventually these are big decisions that won't be scaled back or scrapped just because of a temporary thing like a protest. And there have been protests in Paris, but the banks are making efforts to make sure that the people they relocate to Paris are settling in for the long term. They provide French lessons, they help them find schools for their kids. They're not just providing a 2-year stint in Paris. They are really looking to make the financial ecosystem here in Paris grow and see people get a career here.
Alex, Raj Bandari, on that shift then from London to Paris, it has momentum. Stay with us. Bloomberg Surveillance Early Edition continues in the next hour. This is Bloomberg.